Small business funding, best grants and loans for fast growth. Small business funding for startups. Imagine you have customers waiting, bills to pay, and your business is ready to grow. But you are stuck because you do not have enough cash. That is why funding for startups is so important. The right funding helps you buy inventory, pay your team, launch marketing, upgrade equipment, or keep your business running smoothly until sales become steady. The challenge is not just finding money, is finding the right funding at the right time with terms your business can manage. Startups move quickly, so making smart funding choices gives you room to grow. Bad choices can hold you back for years. How small business funding for startups really works. Many new business owners think that if their idea is good, getting funding will be easy. But lenders look at risk first. Startups are new, may not have steady sales, and usually have a short credit history. This does not mean you cannot get funding, but does change which options are available. For new businesses, getting approved for funding depends on several things, not just one. Your personal credit matters. Your business bank account activity matters. Lenders also look at how much money your business earns each month, what industry you are in, how long you have been in business, and how clearly you can explain why you need the funds. Some care more about your current cash flow, while others want more paperwork and financial history. Pick funding that fits where your business is right now and helps you take the next step. The main funding options startups should consider. Startup funding is not just one thing. There are different tools for different business needs. Business term loans. A term loan gives you money up front and you pay it back over a set time. This is good for one-time needs like buying equipment or launching a campaign. The benefit is predictable payments, but it can be harder for new businesses to get approved. Also, fixed payments can be tough if your sales are not steady yet. Business lines of credit. A line of credit gives you access to money up to a certain limit, and you use it when you need it. This is helpful if your cash flow goes up and down. You can cover short-term gaps or emergencies without taking more money than you need. Just know that new businesses may get lower limits and costs can vary. Short-term working capital. Short-term working capital is for when you need money fast to run your business, buy supplies, or handle new demand. It's usually easier to get than a bank loan, but it often costs more. This can still make sense if the money helps you make more sales quickly. Equipment financing. If you need to buy equipment for your business, equipment financing can help. The equipment itself acts as security, so it can be easier to get approved. This lets you keep your cash for other needs, but is not helpful if what you need is money for payroll, rent, or general expenses. Merchant cash flow-based funding. Some businesses with steady sales or card payments can get funding based on their revenue instead of credit checks. This is helpful if you need money quickly to support growth or keep your business stable. It usually costs more, so use it when speed is more important than price. What lenders and funding providers look at. If you want better results, think like an underwriter. The question is not only whether your startup needs money. The question is whether your business looks able to handle repayment. Revenue is often the first checkpoint. Even a newer business becomes more fundable once deposits are regular and sales show a pattern. Personal credit also matters, especially when business credit is thin. Strong bank statements help because they show how money moves through the business in real life, not just in projections. Time in business matters, but not always in the way founders assume. A business with 6 months of stable revenue may be more attractive than one with 2 years of weak performance. Industry also counts. Some sectors are viewed as lower risk, while others face stricter scrutiny because of high failure rates, chargebacks, seasonality, or regulatory issues. Documentation can make or break speed. If your records are scattered, approval slows down. Clean bank statements, basic financials, business formation documents, and a clear explanation of fund use can significantly accelerate the process. How to improve your approval odds fast. Many startup owners apply too early, ask for too much, or apply without a funding plan. That leads to rejections that feel personal but are usually operational. Start by matching the amount you request to a specific business purpose. A lender is more comfortable with, "I need $25,000 for inventory, equipment, and launch marketing tied to sign contracts," than a vague request for growth capital. Specificity reduces perceived risk. Next, tighten your business banking. Avoid mixing personal and business expenses. Keep deposits consistent when possible. If your business is generating revenue, even modest revenue, make sure your statements clearly reflect it. Lenders focus on the stability of your cash flow. It also helps to know where you stand before applying. Check your personal credit, Review recent bank activity and understand your average monthly revenue. If one area is weak, another may compensate, but only if you present the full picture clearly. Working with a solutions-focused provider can also save time. Instead of chasing one narrow option after another, you can look at multiple funding paths based on speed, revenue, and business profile. For startups, that flexibility matters because the right product is rarely the same for every owner. Choosing funding based on your real business needs. Not every funding need should be solved the same way. If you are opening a location and need a larger amount with structured repayment, a term loan may make sense. If your sales are growing but cash is uneven from week to week, a line of credit is often more practical. If opportunity is immediate and delay will cost you revenue, faster working capital may deliver more value despite a higher price. This is where founders get tripped up. They compare rates without comparing the use case. Cheap money is not always the best money if it arrives too late or comes with requirements your startup cannot meet. Expensive money is not always bad if it helps you fulfill orders, retain customers, or prevent a cash crunch that would hurt the business more. Compare total funding costs, payment schedules, speed, and impact to ensure it solves, not creates, problems. Common mistakes startups make with funding. One mistake is borrowing without a repayment plan tied to revenue. If the capital is going towards something that does not produce income or improve efficiency, repayment becomes harder and faster. Another mistake is overborrowing to create a larger than necessary cushion. More capital can feel safer, but it also raises your cost and pressure. Some founders wait too long. They apply only when cash flow is already critical, which limits options and forces quick decisions. Others do the opposite and apply before the business has enough activity to support approval. Timing matters. There's also the issue of chasing traditional bank standards too early. Banks can be a strong fit for established businesses, but many startups need funding options built for speed, flexibility, and real-world operating conditions. That is not settling. Is chosen based on the stage, when speed should be the priority. For many startups, the question is not whether funding is needed, but rather how to secure it. Is how fast it can be accessed. If payroll is due, inventory is discounted for a limited time, or a new contract requires immediate fulfillment, waiting weeks for a decision may cost more than the financing itself. Fast funding works best when you know exactly what the money will do in the next 30 to 90 days. That could mean covering a gap before receivables come in, buying product ahead of a busy season, or investing in marketing with a short sales cycle. In those situations, speed is not just convenience, is part of the return. That is why many owners look for providers that can quickly evaluate business performance and present practical options without making the process more complicated than it needs to be. AVI Business Solutions is built around that kind of access, with funding solutions designed for business owners who need momentum, not delays. Ultimately, the best startup funding is the kind that enables you to move forward with control. If the capital gives your business room to operate, sell, and grow without creating unmanageable strain, is doing its job. Start there, stay realistic, and choose funding that matches what your business actually needs next.
Running a small business means being ready for anything. But what happens when the big banks say no? At AVI Business Solutions, we say yes.